Well, that's another auto company that has disappointed with the actual numbers reported versus the expectation, and that's TVS Motors. Though the number this time was quite a miss, but the management outlook was quite robust this time. Firstly, let me take you through the numbers. Then the revenues recorded by the company were almost in line to our expectation at 3,934 crores. But what was a miss was in terms of EBITDA, margin, and in the bottom line, the profit was definitely a miss. The company recorded a EBITDA of 273.8 crores. The margins were at 7% versus our expectation of 8.3%, and the profit was actually half to what we were expecting at 53.2 crores. But this time the product mix was quite good, as the company's overseas business actually performed really well, and the company records highest ever quarterly revenue in the international business. And not only that, they are expecting to hold on to this kind of a momentum in the performance over there and in the domestic market as well. They are hopeful of a very good recovery, and especially as the rural demand will pick up as per them in the times ahead. The management expects the profitability margins to bounce back to the peak levels of 10 percentage points above that was witnessed by the company in the Q4 of FY21, as they are hopeful of a good volume pickup towards the second quarter of FY22. And not only that, we know that the margins have been hit for all the auto companies due to the commodity price inflation, but the TVS Motors has been taking the price hike. They do inform that they did take a price hike of 1.1% in the month of April, and also in the month of July they hiked their prices by 2.4%, and going forward, if need be, they will continue this trend in order to pass on to the price hike to the customers and hold on to their margins and the volumes as well, which will help the margins of the company to bounce back to the 10 percentage points, which is their target. Now the company is experiencing a gradual easing of the semiconductor shortage issue, which is positive because this has been impacting just one model of the company, but that's a good model, that's Apache for the company, and the opening up of the international markets across will help the company to build into the volume progress in the times ahead. Another positive in the result was the company indicated that this increasing focus in the EV space. For FY22, the company has planned a Capex of around 800 crores, which will be predominantly towards the EV, new products and new generation technologies. So that was TVS Motors on the numbers reported and what is the management outlook on that. But now let's talk about what are the brokerages targeting on that. So let's firstly take up Citi. They do maintain their sell rating on the stock with a target price of 530. They say that there has been a slight operational beat, but talking about profit, that was impacted due to higher capital cost. They are positively surprised by the realizations recorded by the company in the Q1, and this has drove the EBITDA to give a beat over there. The company's pricing and the gross margin trends have been commendable as per them, but the valuations bake in the margin improvement that the company is hopeful of. Now taking another brokerage that is too not positive on the stock, that's Credit Suisse. They maintain their underperform rating with the target price of 542. As per them, TVS trades at 22.4 times of FY23 price to earnings multiple, and that's the most expensive two-wheeler stock as per them. They retain the underperform rating as the inflection market share headwinds, which put the premium valuations of TVS at risk as per them. So that was TVS Motors. Brokerages are not positive. There was a slight miss on the numbers this time, but the management is quite hopeful of a good recovery in the times ahead, and EV could be a game changer over there.